Good afternoon, everyone. My name is Jennifer Prew and I'm Head of Professional Development at the Chartered Banker Institute. So thank you very much for being able to join today's events. A couple of housekeeping points, if I may. Firstly, to remind you that this webcast will be recorded and will be available to play back after the event. Now, it will last for approximately 1 hour, and depending on how we're going time-wise, we will try and have the opportunity for questions, but if I can ask everyone to keep the questions to the end rather than posting them as we're going along, that would be much appreciated. So as you may be aware, the Chartered Banker Institute has almost 150 years experience in educating bankers, and we have a network of 30,000 professional bankers across the globe, and we're proud to be regarded as the leading voice of responsible and sustainable professionalism in banking, and that ties nicely in with the webinar today. So our topic is the importance of CDFIs and credit unions in supporting responsible finance. And I'm delighted to be joined by two expert panellists. So we have Theodora Hadjimichael, who is the Chief Executive of Responsible Finance, and Marlene Shiels, OBE, who is the Chief Executive of Capital Credit Union. So welcome. It's fantastic to have you both with us today, and I'm very much looking forward to the conversation that we're about to have. So if it's all right, let's start first of all by talking about vulnerability. It's recently been reported that over 14 million people in the UK are considered to be financially vulnerable. Now, that's a huge number, and it's never been more important to understand the potential for vulnerability and the needs of those that can become vulnerable. So Marlene, I wonder if we could start with yourself, please. Are you able to share some thoughts on that with us?
Yeah, thank you very much, Jennifer. It's really delighted to be here today and to get a chance to talk a little bit more about credit unions and CDFIs and indeed the importance that they both play in society at the moment. And as you rightly said, all the statistics that have been coming out of government over the last 12 to 14 months as a result of the pandemic in particular has shown that vulnerability is very much at the forefront. Vulnerable consumers are very much at the forefront of what we do in credit unions and CDFIs. And indeed, over the last 12 months, as you know, also the Money and Pension Service has done a lot of work, as has the regulator, the Financial Conduct Authority. So, for us as a credit union and indeed in the credit union movement, we've been very well versed with dealing with vulnerable customers. It's part of our DNA, and we've been doing this for over 30 to 40 years, because principally we will be working with a lot of people who would be classed as being financially excluded. But of course, vulnerability is much bigger than just financial exclusion. As we know, people can become vulnerable for all sorts of reasons. But I think where the regulator is coming from and what we recognize as credit unions is that people can go in and out of vulnerability as well, which is not new, but it's certainly challenged us to look at vulnerability in a very different way, if you like. Certainly, during the pandemic and indeed when we come out of the pandemic. We know some of the statistics, over 14 million adults have less than £100 in savings, for example. So if they get an emergency and, they don't have any savings to fall back on, that can put them in a vulnerable position because they can't afford to deal with that emergency. But, pre-emergency, they might not have been classed as vulnerable. So there's lots happening in this space, lots happening in credit unions, lots happening in relation to the way we do things, how we work with our members, how we ensure that if they are in a vulnerable position for any reason, that as a credit union, we're not making that position worse, that we're working with them to get them through whatever hurdle they might be facing at any given time. So, that goes to the heart of the organization, how we do things, the way we do things, our culture. And it hasn't changed so much, but we've certainly had to go back and look at the credit union and how we have dealt with people in the past and make sure that we are right at, we're asking the right questions of our members, that we're probing as much as we can to make sure that if they are on the cusp of vulnerability or indeed they are in difficult difficult circumstances, that we're working with them and we're not putting them in a worse position, if you like.
Thanks very much for that, Marlene. I wonder if I could now come to Theodora, and if you could share your thoughts on the vulnerability aspect, please.
Yeah, definitely. And thank you, Jennifer and the Chartered Bankers Institute, for having me on today. And it's a real pleasure to speak alongside Marlene as well about the role that the wider affordable credit sector has to play. So today's discussion is a really timely one, I think, and especially this question on vulnerability is very timely. As we've both touched on, millions of people have been financially affected by the pandemic. And I think personally, we've probably all seen that either through our own families or someone we know has been financially impacted by the pandemic, either through losing a job or a partner losing a job or going on furlough or having hours cut. So when the FCA says that everyone is at risk of becoming financially vulnerable, I think we've really seen that play out during this pandemic. And so that's why it's just such an important topic to keep talking about and coming back to. From our perspective, I guess we could come at it from the responsible finance and the CDFI perspective. So to tell you a bit about what we do and our role. So responsible finance is an industry association for social lenders. Our members are often called community development finance institutions, or CDFIs, and that just means they're not-for-profit lenders. They've been set up to serve financial exclusion or fill a gap in access to finance for people, small businesses, social enterprises who, for a variety of reasons, are considered higher risk and therefore can't get access to mainstream credit. Our members largely provide access to credit, but they also provide access to other services like advice, budgeting, benefits checkers for people to check if they're eligible for additional income, and access to savings and other products, which all, as a whole, all improve financial resilience. Responsible Finance has about 50 members, 10 of which lend to consumers. They lend about 25 to 30 million per year to about 35,000 customers. What our traditional product looks like is that its average loan size is about £500 over 5 months. By the nature of what we do, so lending into what's often called the subprime or non-standard market, like Marlene said, most of our customers are at risk of being, or are at a higher risk of being vulnerable because they're on low income, or perhaps they're working part-time and have unstable income. They're part of their income, they're relying on benefits and need to supplement it with credit. Perhaps someone in their family has a disability. So this topic around identifying vulnerability, that's really relevant to us because it's a constant thread in our work. And our experience throughout the pandemic really reflects what the FCA came out with in its Financial Lives survey a few months ago, which is that while there was a positive trend around vulnerability pre-pandemic, that has been reversed, and more households are now at higher risk of vulnerability. And like Marlene said, have much less of a many more households have much less of a financial buffer now to cope with unexpected income shocks. And that's what we've seen, and that's what our members have seen as well. And our traditional customer pre-pandemic was female, under 30, living in social housing, income under £20,000 per year, maybe single parent. But now we're seeing a range of demographics like the self-employed, who have lost income, those who have been made redundant. And I think for us looking ahead at the end of furlough in a few months, I think we expect that trend to continue as unemployment potentially increases. So the goal of the sector is really to sort of combat these trends and build financial resilience so that when there are these periods of increased vulnerability, and as Marlene said, going in and out of vulnerability, when someone loses a job or a relationship breaks down, that harm isn't caused by our financial products, because that harm can have a really long lasting impact on someone's ability to get back on track after this event and fully contribute to society again. And from our perspective, we do offer a range of wraparound products, but at the core of it, we are lenders and we are affordable credit. We know that the majority of adults use some form of credit at some point in their lives. And in our specific markets, providing these small value loans to customers at a higher risk of vulnerability, we're walking a real tightrope of affordability, creditworthiness, vulnerability. And our members do it really well. And I think, Marlene can speak to that as well, but they have, really high success rates in terms of customers repaying. They have really good customer satisfaction. And we hear so many incredible stories about how people are able to get on the right foot because a CDFI took a chance on them and were able to look under the skin and see their future viability, their future ability and potential to repay. And one example is, we had a lady who applied for a loan from one of our members to buy a cooker, and that meant that she was going to save a lot of money on takeaway because that is at a huge premium, buying takeaway for several meals every day. So that is, being able to look at uses of credit and how credit can improve lives. That's, a real asset and a real benefit of how the sector is different and approaches this market differently. And I think like the CDFI sector and credit union sectors are similar in that they take a higher touch approach. They really know their customers. When you're walking that tightrope, you have to know your customers really well. And more CDFIs are also incorporating data and use of open banking in terms of recognizing patterns in income and expenditure and using that to, identify future viability for their customers and also pinpoint areas where of financial vulnerability. So I think as a final point, I think what the FCA does is sort of on the vulnerability side of things, it highlights, what can go wrong. But I think what the CDFI and the credit union sectors do really well from their long track record of working in the sector is to show how it can be done really well, what the sort of positive impact of finance is, and what the impact of having that customer-centric approach, having an organizational purpose that is totally aligned with getting good customer outcomes and having those good customer outcomes baked in across products and processes. And that's just so core, and like Marlene says, in our DNA around how we deliver products that are really fit for purpose for our customer groups.
Thanks very much, Theodora. Again, lots of very interesting points. And Marlene, would you like to come in with any other points here?
Yeah, I would. Thank you, Jennifer, and thank you, Theodora, for, I agree with absolutely everything that Theodora has said. And just to add maybe one or two elements to it, Theodora touched on this quite a bit, but just to also talk a little bit about when people do become financially vulnerable, it impacts, in so many other parts of their lives. It impacts on their families, it impacts on their mental health, it can impact on their jobs. And we know some of the statistics, the number of work days that are lost every year. Over 15 million work days, productivity days, are lost in the United Kingdom every year because of people who are financially stressed and they're worried about their finances. And that's where, CDFIs and credit unions do a really amazing job, particularly as Theodora said, at the lower end of the market, where someone might just want, they might need £100, £250, £500. And the reality is that there's not many providers at that end of the market other than CDFIs who will lend such a small amount, but that might be the amount that someone needs just to get back on track. And again, just to add to it, where credit unions are also trying to ensure that financial resilience is key as well, of course, because we're savings institutes, and with credit unions, most credit unions, you can save from as little as £1 a week. And you might think that's a very low amount, but when you start to build that up over a month, over a year, over 3, 4, 5 years, it really is giving people a nest egg that they can fall back on, and it gives them that comfort. If something does go wrong, that they may not need to borrow, they might actually just fall back on their savings. But it gives them that comfort if an emergency comes down the pipe, that they're not going to have to worry maybe as much as they would have done if they didn't have the savings. So, that's a really critical element to that financial resilience as well. And certainly at my credit union over the last 14 months, we've had a really long, hard look at what Capital Credit Union has been delivering to our members. We're savings loans, and in a very small way, we offer mortgages as well. But the pandemic has certainly taught us that we have to look at things differently, and we have to put ourselves in our members' shoes and look at where they are currently and what their needs are, not just today, but going forward as well. And we've changed our whole business model. We've changed our whole offering as a credit union in order to ensure that those members who might either fall in and out of vulnerability, or who might become financially stressed or financially squeezed, and that we're there, and we're there and helping them in a way that they need when they need it. And as I say, there's very few financial institutes in the United Kingdom other than credit unions and CDFIs that will work with people who are in the subprime market and will meet their needs when it's a very, very low amount that they need just to get them over whatever challenge that they're facing. And I suppose just the last thing I would say about it as well, the work that we do in credit unions and CDFIs, building that financial resilience, making sure that people have a place to go when they need to borrow that small amount. It's the mental health side of it as well. We've seen mental health issues rise exponentially over the last 12 to 14 months, and a lot of that is about financial well-being. It's about financial resilience. And again, I think it's, I don't think I'm over egging this at all, but certainly, we've seen it with CDFIs and CDFI customers and credit union members, and we are helping get people back into work. We're helping them with their mental well-being. We're helping them with their financial well-being as well, and to make sure that they can go to work if they're in work, that they're not worrying so much because they have somewhere to go, they have somewhere to, as I say, fall back on their savings or get a small loan at a reasonable rate. So it's a whole package. It's all wrapped up together, isn't it? It's it's not just one thing. It's not just getting a loan and getting over that hurdle. It's the whole package that we're about.
I think so, and based on that, one of the key points that jumping out to me is quite simply that anyone can become financially vulnerable, picking up on a point that you've both actually raised. It could happen to absolutely anyone through a variety of different means. And I think the work that the CDFIs and the credit unions are doing to help support individuals is absolutely fantastic. So I would like to move us on to our next topic, which actually I think we've covered a couple of points anyway. but it's really with regards to the importance of knowing your customer. I think it was something that Theodora mentioned specifically. So the importance of knowing your customer, but also being able to design products and services aligned to the FCA guidance. And I'd be interested in hearing more about this. And if I could start with Theodora this time, if you could pick up on some points there, Theodora, that'd be grand.
Yeah, definitely. So I think, I mean, the FCA just released some new guidance a couple months ago on vulnerability, which is again really timely, just knowing that I think, you know, nearly 4 million more people are exhibiting, are in circumstances of financial vulnerability because of the past year. And, you know, like I said, we're facing a lot of uncertainty with the end of furlough, the payment deferrals. So it's really timely for the FCA to put out more guidance. And I think what, you know, the guidance is very clear on the role that firms and financial firms have through their lending products. And that, you know, the products and processes have the potential to cause harm if a customer's in financial circumstances, you know, even if it's unintended, it has the potential to cause harm. And therefore, there's a really strong, you know, call to firms to think about how to prevent harm in that case. So again, you know, I go back to, it's, you know, it's sort of talked about a lot with the climate risk side of things. You know, people talk about not doing anything bad, but it goes beyond that, I think, for us, which is not only don't do anything bad but finance has the potential to do really good. And, you know, flip it on its head. It's not only about not doing harm, it's about using finance very positively and as a bridge for consumers to, you know, to be able to access opportunities, like Marlene said, around, you know, being able to get a loan to, you know, be able to fix your car so you can get to work or go to a job interview. So it really does provide that bridge to financial opportunity. And we had Responsible Finance had this series of events and webinars over the past couple of weeks, which raised a lot of interesting questions. And one quote that stood out for me from one of our speakers was that she said that when firms talk about their outcomes, they're often talking about the majority, and often where new regulation or new legislative intervention is introduced, it's to protect the minority. And that point was really salient for me because, you know, here it's really it's the minority of people who might fall into financial distress and be unable to make a repayment or go into arrears. But it's really that minority that we need to design, that the wider system needs to design its products around to make sure that they're getting really good customer outcomes for people who might fall into financial distress, because the impact is so disproportionate. If they're not able to get back on their feet, if, you know, that financial process does cause harm, that has such a big impact on that community, on that person's life, on the community they're in, on their family, on the sort of local economy. So it's really important that we do design products with the minority in mind, and with you know, bearing in mind that this vulnerability point. So I think for us, it's again around, you know, our members are very embedded in their communities. They really understand, they have a long track record of working and really understanding their customers' financial lives, and sort of what products might you know, what products are tailored and are a good fit for them. And they're able to, because we're relatively small organizations, we're able to be flexible and be agile and design new products and services that are really supportive for the circumstances that our customers are in. So for example, at the very start of the pandemic, one of our one of our members launched this service of customer care calls, where they were able to identify customers within their customer base who were at higher risk of vulnerability for a variety of reasons. And they reached out to them just to check in on how they were doing. You know, again, it's not necessarily related to the loan that they had with them, but it was more just checking, you know, did they need groceries? Did they need, you know, were they okay? And the response was phenomenal, because the people really appreciated that. It was probably, I think for a lot of people, it was the first call they'd gotten from anyone. And so that was really amazing. And I think, you know, it's helpful for the customer, but also I think it has an impact on the firm as well, and the ability for that customer to repay their loan, to trust the to trust that CDFI. That's why, you know, one reason that, you know, we have such good customer outcomes is that because there's this high level of trust, there's this high level of, you know, cross understanding. And it just reminds me of another thing that one of our speakers said from last week. She was from a local government, and she said, helping people with their money helps us deliver better services. I think that's such a fundamental thing in recognizing that financial stability and it doesn't only get good customer outcomes, but it actually has really good outcomes for firms and companies as well. Because, you know, as we've said, if you're able to pay bills on time, be productive at work, that's actually a real incentive for not only CDFIs and credit unions, but the wider financial services sector to design products with the customers who will use it in mind, and particularly those minority cases in mind. So those are a few thoughts from me on this.
Okay, thank you so much. And trust is absolutely crucial. And I know that when we're going through this conversation, Marlene's nodding along to a lot of the points that you're raising, Theodora. So I'll now jump to Marlene and ask her to share her thoughts.
Yeah, thank you for that, Jennifer. And again, Theodora, agree with entirely everything that you've said. Maybe if I could just come at it from a slightly different angle and, you know, talk about credit unions a little bit more. So for credit unions, we have members. So our members own the credit union. So I think that initially, you know, getting your head around, well, what does that actually mean? Well, it means that every one of our 25,000 members is actually an owner in the business. So by the very nature of that, of course, the relationship is going to be different. And I use that word relationship because that's what we're about. We're about building a relationship one member at a time, because they are the owner of the business. And I think that puts a very different slant on it. But certainly in terms of the last 14 months, you heard me say a few moments ago that a capital credit union, and I know many credit unions are doing this as well, we really took a long, hard look at ourselves internally. And, you know, part of that was about the products that we offer, and are they the right products, particularly in the current environment. And what we ended up doing actually as a credit union, we came up with our COVID financial well-being package. So we looked at everything we did and everything that we think we're going to need to do going forward. We talked to our members quite considerably over the last 14 months, whether that was members phoning up, you know, just maybe for a savings balance or a loan, or, you know, they were having difficulties paying a loan, whatever. Every opportunity that we had, we spoke to our members and we said, what do you need from us? And if I could just digress slightly before I talk a little bit more about the wellbeing package, but like Theodora's members, you know, I found myself last summer, myself and my team, we were going out and we were delivering food parcels to members, because they would phone up, you know, they'd been furloughed, they'd lost their job, you know, the benefit system hadn't kicked in, and internally we did a big drive with all of the staff and our board members and other volunteers, asking them to donate, and much in the same way that most people across the country were doing. But we actually delivered food parcels to members who were really struggling, really, you know, at the coalface of struggling. But getting back to the wellbeing package, so what we've done is we've taken our whole offering, if you like, on behalf of our members, and we've broken down the whole offering into 3 areas. So we have education. Now, credit unions have always been working with our members and educating them, in different things, whether it's budgeting, how to stay safe online, all of these kind of things. But we have really ramped that up over the last few months to try and make sure that members, are really thinking about what they're doing, how they're spending, how they're budgeting, how they're planning for the future, how to stay safe online, all of those things. But more importantly, what we've also done is in the product area over the last couple of months, and we've launched 2 new products here at Capital Credit Union. And we think we're the first credit union to do one of them, which is we've brought in a new loan, which is, we call it our Take a Break loan. And we did this right off the back of what the FCA was driving all financial institutes to do right at the beginning, which was if someone was struggling to pay, give them a payment holiday. So actually, we've developed a loan that you have payment holidays built in from the day you sign the loan. You decide the frequency of those payment holidays, but it means then that you have some comfort that, if you have an emergency or you have a month where you're getting a little bit less in your benefits or your salary, and you're just struggling that particular month, and you can just phone the credit union and say, I don't want to pay my loan this month, I want to take my break. So that's just, members told us that's what they wanted, and that's what we brought in. And the other loan that we brought in was a new flexi loan, as we're calling it, and it gives members the ability to be, I suppose, in its simplest form is we will provide the member with a cap, a loan amount, and they can draw down up to that cap as often as they wish. And if they don't draw anything down, if they just want that loan sitting in the background, just in case, but if they don't draw anything down, they never pay anything for it. There's no cost to the loan at all. It's only if they start to draw funds down, then they pay interest on those funds. But it's just another way of giving people that little bit of comfort. If something happens, if something goes wrong and they don't have the savings to fall back on, then they can draw this down. It's like a pre-approved loan, if you like, with a cap, and it just sits there until the member needs it. So it was very much members were saying, this is what we need during COVID. We're likely to need this after the pandemic. So we'll keep these products, going for as long as our members want them. But they were very much designed with the member in mind, because that's what members were telling us they needed over the last 14 months. And then service, we've introduced some new services that we as a credit union didn't have in the past. So as I mentioned, we're very much about savings, building financial resilience, affordable ethical borrowing, and we also do mortgages as well, principally around first-time buyers, right to buy, rather than mainstream, a bit more niche. But over the last couple of months, we've been doing some other work. We're partnering more now with organisations, local authorities, CIBS, Step Change, and we're partnering more to deliver, a more all-round financial service. But what we've also done as a credit union, which we haven't done in the past, is we're just about to recruit some people that will be able to give regulated debt advice as well. So if a member comes to us, rather than handing them off and signposting them somewhere else, we'll be able to do some of that work internally as well, and just get them into a better footing and help them get back to where they need to be. So know your customer. Well, we've got 25,000 of them. They own the business, so it's our business to make sure that we do know them, we know what their needs are. And that's just through talking to our members regularly, and creating the forums where they can talk to us. We do surveys, we do focus groups and so on and so forth, just to make sure that we're talking to them on a very regular basis and understanding their needs.
I think what's very clear to me, listening to both your conversations there, is that it's actually doing something for the member or the customer that's going to make a real difference to them. It's absolutely crucial, and you can only do that by knowing them, by listening to them, and by being able to help them. So thanks for that, Marlene. Theodora, is there anything you would like to add to that before I move on to our next topic?
I think Marlene made some really good points, and one thing that we often think about is how community finance and CDFIs and credit unions can be this one-stop shop, because you know, particularly when you're living on a stretched income and, you know, kids at home, reduced hours, you know, it's a real juggling act. And there's often, you might need credit, but there's often a lot of other things that you could benefit from. So I think having this one-stop shop, where there's a range of services in addition to affordable credit, is a really key way, and is, you know, a way of offering these sort of bespoke, tailored products that really improve people's financial lives. So that's, I think Marlene outlined it really well around how these products can all interact, but that's a concept that, and a model that we're really keen on. And I think partnerships, as Marlene said, is in collaboration is a really key way of being able to both deliver that range of services, but also I think a way of bringing more customers into the ecosystem, because this, you know, range of partners, you know, CDFIs, credit unions, CAB, local charities, we all have a shared, housing associations, local authorities, we all have a shared community. So I think by bringing them all together, it's a way to provide that one-stop shop, but also make sure that more people are in the ecosystem and not falling out of it.
Okay, thanks. That's a really good summary there, Theodora. Thanks very much for that. So I'm going to move us away from that topic slightly, and I think we'll come to you this time, Marlene. And from the credit union angle, we've been hearing a lot about building back better and levelling up, and I imagine that situation is going to require different business models to flourish. So I'd like to know more about that from the credit union point of view, please.
Yeah, no, that's a really good question, Jennifer, and certainly some of it I've already touched on, I think, but just to add a little bit more about, you know, building back better. And one of the things that has been proven, and I think this will be the same for CDFIs, and I'll let Theodora talk about that, but certainly one of the things that has been proven about credit unions, when people borrow and when they save with a credit union, more often than not, the spend that they have, whether it's their savings or whether it's their loan, the spend happens locally. And for us, that's, you know, that's kind of, it's completing the circle, isn't it, if you like? So, you know, as a credit union, building financial resilience, building wealth, and creating also the ability to borrow ethically and borrow at low cost, you know, that's part of the business model. But when you are not only helping your member, when you're helping your member's local community, and you're helping the community that we work in and indeed live in, and certainly for me, where my credit union is, you know, that leveling up, I think it takes many forms, and it's, you know, it's not just about the finances, it's about creating something that everybody can benefit from, whether, as I say, it's the member, whether it's the local school, whether it's the local housing association, whether it's the local authority. I mean, Theodora mentioned that earlier, you know, in terms of collaboration and another guys as well, but it's making sure that we're creating something that everybody's benefiting from. And if our members benefit ultimately, but everything around them, as I say, family and businesses that they're spending their money in, businesses that they're partnering with, everybody, it's a win-win-win, isn't it? And for all of us. And I just wanted to also say, before I hand over to Theodora, I just wanted to build on what Theodora was saying about collaboration as well. We certainly see that as the future. And, you know, I'm hoping we've got a lot of banking colleagues on the call today, and this might just spark something in their mind about collaborating with a CDFI or collaborating with a credit union. And both Theodora's members and credit unions are doing that somewhat, but it could be so much more about working together and, you know, providing that all-round service. So if a bank can't deliver something, but they know the local credit union can, or the local CDFI can, let's talk to each other, let's collaborate, let's create that level leveling up for everyone and not just for those, you know, who are at the lower end of the financial marketplace, if you like. I think there's so much we can do together. There's so much we can do to get the whole country out of the pandemic together and build back stronger and better. And as I say, that's not just our customers, that's not just our members, that's not just our local communities, but every firm that engages and helps people rebuild, it's going to help their bottom line as well. So as I say, it's a win-win-win for all of us. And so I'd like to see more collaboration. I think Theodora was absolutely right to mention that, and I think we could do more of that across the whole of the financial services sector.
Absolutely. Thanks very much. Theodora, do you want to pick up and share your thoughts then?
Yeah, definitely. Yeah, I really strongly agree with what Marlene just said about wider collaboration, because I think, you know, as we said earlier, when you opened this webinar, you framed it as 14 million people are financially vulnerable, have less than £100 in savings. And at the other end, you know, CDFIs are lending 25 million a year to 35,000 customers, and you know, credit unions have a wider reach, but still together, it's nowhere near 14 million. So there's this gulf that we need to bridge. That, you know, we haven't mentioned sort of some of the high-profile commercial lenders retreating, like Provident and Amigo Loans have both been in the news the past couple of weeks. That gulf is just increasing, and so there's so many opportunities and ways to close it so that it can be done responsibly and affordably, and like Marlene said, so that we can build back better, because the sort of principle behind building back better is understanding why we're in such a position where so many businesses and people were so instantly in a precarious position when the pandemic started. Why, you know, how can we how can we build resilience so we can avoid being in that kind of position again? You know, obviously it's unprecedented what the sort of months of lost income, but even at the very first weeks of the pandemic, we could see that so many people were just in such a precarious position that they were instantly affected by the lost income. So it's about learning about that and what we can do differently so that our economic models and our communities can be much more resilient in the future. And part of that, I think, is sort of bridging these silos between the social community lending sector and the mainstream, because ultimately our customers are, you know, they work across these silos, they use products across these silos. So our customers, you know, they'll probably have a bank account, they'll, you know, they'll be making utilities payments. It makes sense for us all to be working together and designing products together and white labeling products together that serve our customers really well. So I think there's a lot that can be done on that. I think a couple of specific things on leveling up, I think it's often thought about in terms of infrastructure and, you know, skills building and, you know, businesses, but prosperity and wealth is at the core of what leveling up means, and offering opportunities to build wealth. And our customers, you know, are traditionally low income, low wealth, poor or low credit scores, so they have, you know, real challenges and barriers to face when building wealth. But by going to a CDFI, you know, for our members specifically, we know that they are so much cheaper than the next commercial option. So our members on a £500 loan save their customers about £260 compared to the next high cost commercial alternative. And that's a huge savings to put back into people's pockets. I mean, we know that 1 in, I think, 9 consumers have a loan out with a high cost lender. So being able to put that money that was going into interest repayments back into people's pockets is a huge way of building wealth and leveling up. I mean, we have a couple of examples. I mean, one of our customer case studies, I think a woman, her story was that she had been homeless a couple times in her life. She needed to borrow a loan. She needed to take out a loan to fix her car to get to work. And she was able to go to a job interview. She ended up getting the job. The CDFI that provided her this loan has a savings product that sits alongside, so customers can round up their loan repayments and deposit the difference into a savings account, creating a small savings buffer. So this woman, she was able to build the savings buffer, continued saving even after her loan was repaid, and built this nest egg that Marlene has talked about. And she didn't need to borrow in the future. She got her own flat. She furnished it completely from her income and savings, and didn't need to take out a loan. I think that's a great example of building wealth and leveling up. And I think when that's done at scale, we'll be able to see a really big difference in in things like the regional inequalities, or inequalities within income disparities within communities. And it's about, I think, getting, like what we talked about with building back better, around being able to join the dots a bit more, being able to collaborate, so that the great work that we're doing and the credit union sector is doing, we can just do that on a much bigger scale and reach those 14 million people, rather than just be able to do it at a much bigger scale. And I think that's when the benefits of building back and leveling up can really be tangible and be seen.
Yeah, absolutely. It certainly sounds as if collaboration is the way to go on that. That's something that came through from both your conversations there. So thanks very much. I'd like to move on to our final question, and it's just a bit of a general one, really. And Theodora, if I can put it to you in the first place, what do you think the future holds for co-ops, social enterprises and mutuals?
I think it's a really good question. I think it's very pertinent as well, because of the ESG agenda is much higher now. The recognizing environmental, social, and governance outcomes and goals seems to be much more prevalent now. And this concept of operating profit with purpose seems a lot more mainstream now, which I think is really positive. And I think it's social enterprise operates in areas that are underserved, or areas where there's a market gap or market failure. And I think having a much stronger focus on in sort of the corporate and commercial space on ESG topics bridges that gap, so that corporates are operating much more closely aligned with with sort of the operating focus and goals that social enterprises have around getting good customer outcomes, serving the consumer, serving stakeholders and not only shareholders. So I think it seems like, hopefully, with the introduction of ESG, the social sector and the private sector are going to be much more intertwined and working much more collaboratively. That's I think a hope and a real opportunity to come out of this. And again, it brings back what we talked about around real opportunities for collaboration, investment. In the US, we saw last year that companies like Google, Facebook, PayPal all put hundreds of millions of dollars of investment into CDFIs, recognizing that it's a really good way of getting money into communities where there's low wealth, racial injustice, where there's been disproportionate impact impact from the pandemic. And I think it's that type of opportunity that we can really tap into here. One of our members has a corporate partnership with Iceland Foods, where they offer a prepaid debit card to Iceland Food customers as a way of diverting families away from using high-cost credit. But it's that type of partnership that it not only benefits the consumer, but it really benefits companies and firms as well, because their customers are better off. Their customers are able to spend more locally, and they're able to reinvest. So I think there's a lot of opportunity to explore in this area.
Okay, Marlene.
I agree again. Seemed to be a day of agreement, Theodora and I, but I absolutely do agree with everything that Theodora said there. But maybe I'll just come at it then from a slightly different angle, because I think she's covered the question off really, really well. But what I think is the future for mutuals and cooperatives and credit unions, well, I genuinely think it's really, really bright, because I think one of the things that the pandemic has taught us is that people need to be investing in people. I think that's one of the things that we need to think about. And mutuals, building societies, credit unions, cooperatives, we do that really, really well. And I think as well, one of the things that I'm seeing is there's a drive for people, particularly younger people, who want to take control of their finances more. And they want to invest, whether that's through savings or borrowing, but they want to invest in companies that are seen to be and doing that investment in other people. And I am a big supporter of green finance, huge supporter, and a big supporter of climate change. I think we absolutely have to get behind those. But if I bring it back down to a much more basic level and think about my credit union, one of the main reasons our members join the credit union, one of the main reasons that the 85 employers that we work with who allow payroll savings, that one of the major reasons is it's because we're ethical, it's because we're investing in each other, it's because we're not for profit, it's because all the profits are going back into the organization. And I think that's becoming more and more important to people, particularly, as I said, younger people. And on that basis, I think the future is brighter for cooperatives and mutuals. And I think as well, and I'm going to be a little bit critical of credit unions here, and I don't know if there's any of my credit union colleagues on the call at the moment, but we've been very traditional. Credit unions looked like a bank branch 30 years ago. That's what we looked like 14 months ago. Well, like every firm, digitization has come in such a wave. And every credit union, or most credit unions, has had to transform in a way that they never expected to do in 1 year. And I think that's what's going to stand us in good stead as well, because one of the criticisms that we did have, as I mentioned, that we were a bit too traditional, a bit too clunky, but that digitization is changing how we deliver services to our members. It's changing how we engage with our members in a way that people want. And again, I think that's part of the future. Now, for us in particular in credit unions, we do have a very restrictive legislative framework, and that is one of the barriers that we need to overcome. And we're working very closely with Treasury and indeed the regulators to make sure that we do get some legislative change to help credit unions grow and not only survive but thrive well into the future and able to serve more people. But that is a barrier, as I say, that we need to overcome. But again, I'm going to say it again because I honestly believe it. Theodora has said it, I have said it, I'm going to say it again. There is so much scope for mutuals and cooperatives to collaborate beyond the mutual societies that I would encourage anyone who's on the call today, if you're thinking anything that Theodora and I have said that resonates, and think, my firm could be working with that CDFI, or they could be working with that credit union. We could be working together to create a much more rounded package for people in all of our communities. Then, I'm sure, Jennifer, you'll be happy to give out our numbers, get in touch with either of us, because I think that is part of the future, is the collaboration. And it's not just cooperatives and mutuals collaborating, but it's the for-profit and the not-for-profit and the more than profit sectors all coming together to make it happen and make it work.
Fantastic. That's a great way to finish up the formal structure there, Marlene. It's almost like a call to action, a call for collaboration. So I'm sure everyone will be on board with that. So thank you very much. I would like to I think we have about 6 minutes remaining. So we have had a few questions posted, which I'll go in. I don't think we'll have time to run through all of them, but I'll certainly select a couple. So let me see. Right. We have one here about a recent newspaper article about banks spending vast amounts of money in the fight against online scammers. And the questions that's been posed is that something that either your organisations have come up against yourselves? So I don't know who's best placed to answer that one.
Theodora, do you want to first, or?
Yeah, sure. I mean, the quick answer is we don't see high rates of scams and frauds, and I think it's because of the higher touch approach that we take with our customers, so that operating, that tightrope of affordability and vulnerability, that we really have to know our customers and understand a person's circumstances, I think weeds out and being able to look in depth at their open banking data, you're able to pick up patterns that would reveal any sort of frauds. I think, as the sector grows and maybe gains profile, it maybe becomes a bigger risk of getting targeted. But again, our core purpose of being customer focused and knowing our customer, providing tailored solutions to their needs, I think still mitigates that risk.
Yeah, I would absolutely agree with that. It's same in credit unions. We're not seeing a high uptake. Well, uptake's probably the wrong word, but we're not seeing a lot of scams or cybercrime. And I think Theodora absolutely hit the nail on the head. It's that relationship and the closeness that we have with our customer members, and also those education pieces that we're doing as well to help them stay safe.
Okay, thank you. Right, I think we have time for just the one more question. So this one is about the FCA, and there's been recently published a consultation on a new consumer duty. And the question that's posed is, what are your views on the new duty in terms of achieving improved consumer outcomes for your members or customers, and what might it mean for individuals working in the sector? So Marlene, maybe one for you initially.
Okay, it's a pity we don't have another hour, because I think we can talk about this, and it's it's so topical at the moment for financial services, isn't it? And the new consumer duty. Well, being a chair of an FCA panel, I know firsthand there is a lot of poor behaviours going out by a small number of organisations. So let's not tar the whole financial services industry, because that's not the case. But there is poor behaviours going on out there, and we need to stamp those poor behaviours out. We need to protect consumers. And this is the FCA's, it's a consultation. So the first thing I would say is, please encourage your firm to respond to the consultation, because it's really important that we get responses from all shapes and sizes of financial services firms. So that's the first thing I would say. I'm very supportive of the FCA's ambition to rid the marketplace of bad behaviour, very supportive of that. And how they ultimately do that, time will tell. And we all have a part to play, as I say, in terms of the response. So yeah, it's really important that consumer duty lands, and it lands in a way it's throughout the whole of the firm. So it goes to the culture, it goes to the processes, it goes to how we market to people. But it is real important that the financial services sector doesn't continue to have such a bad reputation that people don't want to engage. So let's get rid of those poor behaviours. They are small in number, but they're significant. So I'm very supportive of what they're trying to do.
Okay, thanks, Marlene. Theodora, very briefly, any additional points on that from yourself?
Yeah, I think just to echo Marlene, I think it's, the FCA's vulnerability guidance is a guidance, it's not a rule. And I think the consumer duty is one way of ensuring that there is consistent treatment across firms, and it's embedded in culture. And I think it's an opportunity to incentivize some of these partnerships and collaboration and, you know, investment that we've been talking about, because what it will encourage is, you know, activity that's best for the customer. And again, if a bank can't serve a customer, it's an incentive for them to work with their local CDFI or local credit union to make sure that that customer gets the financial services that they need. And also, you know, it's a way for banks to contribute, or, you know, the wider financial services sector to contribute to building a very effective and vibrant community and social finance sector. It provides, you know, the incentive to invest and partner with the social finance sector to create a really vibrant alternative for consumers. So yeah, fully, I think it's an exciting thing to be looking at.
Excellent, thank you. And on that note, we've now reached 2 o'clock. So all that remains is for me, on behalf of the Chartered Banker Institute and our present listeners and future listeners, I would like to thank Theodora and Marlene. It's been an absolutely fascinating webcast. I know that me personally, I've learned a lot from it, and I'm sure that the attendees will be in the same position. So thank you very much for speaking with such passion. That's come through all of your answers. Your enthusiasm has been great. So thank you very much for your time, and we look forward to joining up with you again.
Thank you, Jennifer.
Thank you. Goodbye.